The on-balance volume OBV indicator is one of the most straightforward and widely used tools for measuring momentum and identifying potential entry points. It appears in its own panel below the chart and tracks how volume flows in and out of a market based on price movements. But to really take advantage of OBV, it's not enough to just look at the line direction or confirm trends. You need to understand how its values are built, how volume is added or subtracted depending on the closing price, and what those shifts actually reveal about market pressure behind the scenes. In this video, part of our series The Best Trading Indicators Explained Step by Step, we will break down the OBV indicator in detail. You'll follow the full logic directly on the chart using our custom calculation table and see how it behaves in real market conditions. Clear rules, less confusion, with a practical explanation that finally makes sense. Let's begin by adding the on-balance volume indicator to the chart. On TradingView, open the Indicators menu and type on-balance volume or simply OBV in the search bar. You will notice several results, but for this lesson, make sure to select the one labeled just on-balance volume under the technicals category. That's the official built-in OBV indicator provided by TradingView. By default, the on-balance volume indicator doesn't apply any smoothing. Once the indicator is added to your chart, hover over its name and click the gear icon to open the settings panel. This is where you can fully customize how OBV behaves and appears. Now let's go over the full settings of the OBV indicator, starting with the Inputs tab. At the top, under Smoothing, we have the Type option. By default, it's set to None, meaning no smoothing is applied to the OBV line. If you wish, you can change it to apply a moving average, such as SMA or EMA, but for this lesson, we'll keep it off. The length field controls the number of periods used if you enable smoothing, but since the default type is None, this setting remains inactive unless you change it. BP Sadidi Dev is only relevant if you enable Bollinger Band smoothing, which we won't cover in this tutorial. Under calculation, the time frame is set to chart, meaning the OBV will follow whatever time frame you're currently viewing, whether it's 5 minutes, 1 hour, or daily. The checkbox. Wait for time frame closes ensures the OBV value is updated only after each candle closes, helping to avoid intrabar noise. Finally, under Input Values, the option Inputs in Status Line lets you show or hide the indicator's parameters and real-time values at the top left of the chart. Keeping this enabled is helpful for quick reference while trading. Now let's switch to the Style tab. Here you can customize how the on-balance volume indicator appears visually on the chart. At the top, there's a checkbox labeled On-Balance Volume. This controls whether the OBV line is visible or hidden on the chart. Keep it enabled to see the indicator. Next to it, you can adjust the color, thickness, and line style of the OBV plot. By default, the line is blue with medium thickness and a solid line type, but you can change it to suit your preferences. Under Output Values, the precision setting lets you define how many decimal places are shown for the OBV values. Leaving it at default allows TradingView to automatically choose the appropriate level of detail based on the instrument you're analyzing. Finally, there are two more display options. Labels on price scale adds a marker on the right-hand side of the chart showing the current OBV value. Values in Status Line displays real-time OBV values and parameters in the corner of the chart. This is helpful for quickly tracking the indicator during live analysis. Finally, we have the Visibility tab. This tab controls which time frames the on-balance volume indicator will appear on. You'll see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you define a specific visibility range, like from 1 to 59 minutes or from 1 to 24 hours. If a box is checked, OBV will be displayed when that time frame is active. If it's unchecked, the indicator will be hidden during that range. At the bottom, there's also a ranges option for more advanced visibility control, but in most cases, you won't need to modify it. With all these settings adjusted, your on-balance volume indicator is now fully configured and customized. Now that we've added the on-balance volume to the chart, let's take it a step further. To make the logic crystal clear, we've built a custom version that reveals the OBV calculation, step by step, using each candle's close and volume. This custom panel mirrors the standard OBV but breaks down exactly how each value is formed, so you can follow the logic in real time. At the very top, you see the formula. OBV equals the cumulative sum of sine multiplied by volume. Sine is determined by comparing the current close to the previous close. Right below that, you see C0, C1, and Vol 0. These are the current close, the previous close, and the current bar's volume. These three values are all OBV needs for its calculation. Now let's break it down. Step 1. We calculate delta. This is simply the difference between the current close and the previous close. Step 2. We translate delta into sign. If delta is greater than 0, sign equals 1. If delta is less than 0, sign equals -1. If delta equals 0, then sign equals 0. On the very first bar, when there is no previous close, sign is not available. Step 3. We multiply sign by the current volume to get the increment. This tells us how much OBV should move up or down on this bar. Step 4. We add the increment to a running cumulative total. This is the OBV itself. By summing across bars, OBV builds a line that reflects whether volume is flowing into the market on up closes or out of the market on down closes. At the bottom of the panel, there is also a note explaining that on the very first bar, the increment is not available because there is no previous close to compare. That is why OBV is not defined for that bar. For any trader who wants to go beyond simply applying the indicator, this type of step-by-step breakdown is essential. It shows exactly how OBV transforms raw price and volume data into a running total that many analysts use to confirm trends or spot divergences. On this chart, you can see the single line that represents the on-balance volume indicator. It accumulates volume based on whether the closing price is higher or lower than the previous close, rising when the market closes higher and falling when it closes lower. Unlike other indicators with multiple lines, OBV is a cumulative line that reflects the buying or selling pressure behind price movements. When OBV rises, it indicates volume is flowing into the asset, which can signal underlying bullish momentum. When OBV falls, it shows that volume is flowing out, often a sign of bearish pressure. There are no overbought or oversold zones like you see in oscillators. Instead, you should focus on the direction of the OBV line and how it relates to price action. For example, if price is making higher highs but OBV is flat or falling, that may suggest a bearish divergence. Momentum is weakening despite rising prices. On the other hand, if price is flat or making lower lows while OBV is rising, that can be a bullish divergence, suggesting accumulation behind the scenes. With just this one line, OBV gives you a powerful look into whether volume is confirming or contradicting the current price trend. Now, this is crucial and it needs to be crystal clear. One of the most common mistakes traders make with the on-balance volume indicator is treating it like an automatic buy or sell signal. They see the OBV line ticking upward and immediately go long, or they see it dropping and rush to exit without considering anything else. That's not what OBV was built for. This line is not a magic trigger, it's a momentum-based volume indicator. A tool designed to show how volume is behaving relative to price movements. If you use it blindly without any context, you're setting yourself up for failure. This is why so many traders misuse OBV. They buy just because the line is rising, even when price is already overextended. They sell just because OBV turns down, even when the market is simply pausing or consolidating. That's not strategy, that's chasing signals. To use OBV effectively, you need context. You need to understand the broader trend, the market structure, and how volume is behaving in relation to price. You need to ask, is this move supported by real buying pressure, or is it just noise? Is volume confirming the trend or warning of a possible reversal? It's also important to understand where OBV performs best. This indicator is very well suited for swing trading and position trading, where you're analyzing multi-day or multi-week movements and can give volume trends time to develop. But in day trading, OBV becomes much more difficult to use. Volume shifts intraday can be erratic, and the cumulative nature of OBV can produce misleading signals over short time frames. Trying to extract reliable entries from OBV during fast, low-volume moves often leads to confusion rather than clarity. Here's the truth. OBV becomes powerful when it's combined with other tools. Price action, trend lines, moving averages, or even volatility filters. That's where real strategies start to form, and we cover those in separate videos. But the goal of this video is different. This one is about the foundation. Understanding exactly what OBV shows you and the risks of misinterpreting it. Because no matter what system you trade, knowing the math, the logic, and the behavior behind the indicator is not optional. It's essential. And that brings us to something we'll repeat in every video of this series. Because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory, it's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty. When they treat indicators as if they guarantee success, that mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, the analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, the next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.